So welcome back to Primary Source China Investment. Of course, Peng Guo and I are here, but this week for Show Why, we had a special guest that I interviewed earlier in the week, Chris Zhang from Fortune Securities, and we're going to get to that in a little bit. But today we're talking markets, and there's something going on called dislocation. Well, we're calling it dislocation, and that's not like a spot on Google Maps. What dislocation means is names like Alibaba will continue to get beat down. Tech companies are going to continue to get beaten down. And the real estate sector, which is the cause and solution to all fiscal problems from Beijing's perspective, are going to continue to have volatility. So as Peng Guo has said in the past, this market is familiar with volatility and comfortable. So how do we navigate the inevitable storm that's here and will continue for the next 18 to 24 months? Risk management techniques that we've talked about are ever more important, including asset allocation, equity overlay, trend following. But even at a sector level, and Peng Guo has mentioned this a lot, all sectors don't perform the same. So let's look at year to date. Year to date, financials and consumer discretionals are down the most. Financials down almost 12%, consumer discretionals down almost 13%. But materials are up almost 24%, industrials up almost 7%. So there is some difference within the sectors. And I'm not saying go out and choose these sectors, but just be aware of that. But in the US, if we look at the ride or die K-Web, that's down 43% year to date. CHIQ, which is the consumer discretionary ETF, down 20%, but ASHR is down 5%. Recall, we've been saying that with this dislocation in the market, more companies are going to relist in China. So we had an example this week. China Telecom just listed in Shanghai, raised 47 billion renminbi. That's 7.3 billion US dollar. It's a small dent in the 1.7 trillion that is currently listed here in the US from Chinese companies, but it's a start. And other large cap companies are going to be doing the same going forward.
I think especially for this year, the market really changes. So it's really based on the sector level rather than the entire market. And it used to be sector have the high relationship with the total market index, but right now they are really independent of each other. So generally, the A-share market is like the capital-driven market. So as soon as they get like the white wine, so they get a good performance, and the consumer staples, they have good performance. And then the capital just rush in and put the valuation get higher and higher.
So you mean like Baijiu? You mean Baijiu is like a leading indicator?
Yeah, that's it's used to be like the it's really like the capital driven and especially like the people don't want to wait for the very long term to get the return. They buy it and more and attract more capitals flow into the sectors, which is to get a high valuation. So no matter what happened, and you will see the public wisdom and the people understand that might not be consistent for the long term. The high valuation, like the large cap, they get all the dropped down for this year. I think it is no difference in the investment world. It's really like the mean reversion. So this is other high valued or high growth the sectors get it down, and some of the real estate sectors right now get up again. So it's a back forth. So we see this many times. Unfortunately, just the volatility pretty high, and a lot of the investment advertisement is on the peak of the index. So that's lot of the investors that really get in on the peak or second peak of the this index that's get hurt.
So people, would you say people are focused on growth or value or just indexing, or what's sort of the vibe?
People, I think generally for the general investors, they are more focused on like the theme. Yeah. So, and the past performance. So what's the best past performance is most of the time is in the peak.
Right.
Peak time, you will get the best performance record. And then they decided to, okay, they get a good performance and we buy it, and then they get the mean reversal. Yeah.
Yeah. Yeah. Well, I think the market is going to continue to churn. We're going to continue to see these big names relocate. I think it's a big business opportunity. If you're going to have $1.7 trillion liquidated from the US market and somehow then injected into Hong Kong, Shanghai, or Shenzhen, that's a huge opportunity. And there's going to be a lot of price dislocation. Some of the stocks that get delisted here may go get bid up on the mainland. And the converse is also true. You may get some stocks that nobody wants to sell here, so you're going to have to bid up the price here. So it's going to be an interesting dynamic going forward. And I don't think there's anybody saying it's going back to the way it was. So
yeah, I think the U.S. market is really the important market. It's provided the very liquid market. Asia market also is a high liquid market. Unfortunately, Hong Kong market is really not a liquid market. Most like the institutional clients, if you want to sell the shares, it might hard to find the other parties to take over the shares. So that's why the valuation is lower than the Asia market. So I think it's still might be a good way to consider the liquidity while doing the investment.
Right. Well, that's a good place for us to stop here. And we're going to cut in my interview with Chris Zhang from China Fortune Securities or Fortune Securities. We talked about a number of points that are relative to the investment thesis on the ground versus overseas and looking at China stocks. So as we mentioned, today we're here with Chris Zhang from Fortune Securities or China Fortune Securities. And they put out a great research report that I was reading. And I figured instead of just me diving through that research report, I'd bring Chris on and maybe we can talk a little bit about some of those big points that they were bringing up. And one of those big points that they were bringing up is a follow-on from what BlackRock came out with today. And they're saying, look, US investors have to allocate more to China. It's no longer an emerging market. And from a US investor perspective, looking at China, I'm asking Chris, how do we do this? Should it be A shares? Should it be H shares? What about the US listed Chinese companies? What's the best way to get allocation if you need to get equity?
I think you, for the investor, on the investor perspective, you better get into like Chinese A shares, which is issued by the Chinese company on the Chinese onshore market. And right now, the Chinese regulatory bodies, they encourage the foreign investors to invest in Chinese A shares through two channels, which one is QFII, qualified foreign institutional investor, and the other one is the China Hong Kong Stock Connection Program. So that's both ways you can get exposed to the Chinese A share directly. And the H shares, I don't think there are too much trading going on these days in China.
Yeah. On the A share, here in the US, there's a few large ETFs that for retail, high net worth, those are entities that are not going to go get a QFII license. They're still, just people that are looking to allocate a few bucks to China. Usually we recommend them get the ASHR, which is an ETF traded here. But you brought up an interesting point. What about those big Chinese companies that are still listed in the US? What do you think is the next 6 to 18 months? What do you think is going to happen to them? Are they going to delist here, relist back in China or in Hong Kong? Or are they just going to weather the storm and hope things straighten out?
I think after what happened to the China concept stock listed in US a couple weeks ago, so I think the Chinese regulatory body want to encourage those companies to go listed back to Asia. You can go on listed either in Hong Kong Stock Exchange or China Stock Exchange.
But some of those companies are really big. It will take billions of dollars, either in short-term bridge loans, so they can pay off the shareholders here and then relist back on the mainland. It is a complicated transaction, right?
Yeah, you are right. I think people of the company, they are considering that because they cannot take the, maybe the risk anymore to get hit on the stock price.
Right.
in the
There's a
future.
big price. There's a big price risk.
Yeah.
5, 6, 10% on a few billions. Soon you're talking real money, right?
Yeah. I think like go back to Asia is a good choice for them.
Yeah. So
And
that brings me to my last point is the regulatory environment. You mentioned earlier that there's the Q fee, there's also an RQ fee, there's also the Stock Connect. What's the end game here? Are we ever going to get to the point where we don't need a Q fee license, where we just have an open capital market?
I'm not sure how it goes because the Q fee, you have been in China long enough to know how the Q fee start and then how it goes. And then, it's still like the Q fee is not really take any like effective for the past maybe 10 years or 5 years.
Right.
And the regulatory body just start a new program, I think back in 2019, and trying to encourage more foreign investors to get access through Chinese market in through the Q fee. Q fee structure. So I think Q fee is a good way to invest in China.
The only problem is, and this is kind of a nuanced thing, and the Q fee is still complicated. If you're just a family office here in the U.S. and you want to allocate, a couple $1 million to A shares, it's really hard. You have to go to a Q fee or you have to buy these ETFs here. It's just not a smooth execution. And we do understand that there is some alpha generation in the China market. There is some stock picking prowess. I don't want to deny all of that, but it's very hard for family offices or high net worth individuals to access that kind of path.
I understand what you mean. Like always Chinese market have the best alpha in the world, but have the worst beta in the world too. Because
I'm going to steal that line. Best alpha, worst beta. Yeah, we have a lot of people searching for alpha, but forget the beta.
Correct. And also you can see the quantitative investment just have a booming in China these days. They have very low.
Yeah, we've talked about that, and we also talk about uptrend a lot. There's a lot of ways to grab uptrend.
But still, you need to keep the return risk balance always.
Look, Chris, I've been saying this since 2008 when I arrived at Guotai Jijin. I don't want to hear about your return. I want to hear about your risk-adjusted return. And all of a sudden, all the PMs, they don't want to talk about that. But that's a real issue. When you're taking on a lot of risk, you have to get a lot of return. The beta, like you said, it's the worst beta. The Sharpe ratio for a CSI 300 is like 0.5. It's just terrible. So that's what scares a lot of people away.
But still, there's a long way to go. I think the China market is changing. It's getting
absolutely. And I think a lot of these big winning names relist in A-share market. The A-share market's going to get a lot more serious, a lot more sophisticated, a lot more large caps that are growing instead of the old school big bank large caps that aren't growing as fast. Yeah. So, it'll be interesting to watch. So we're going to leave it there. Chris, thanks for joining the show this week. We really appreciate it. This week on policy, we wanted to talk a little bit about what shared prosperity is going to look like. You're going to hear a lot about this because it came out in the press, it came out in the political speeches. And what does it mean practically? When I first heard it, it reminded me of an advertisement which said, "A chicken for every pot," which ran in October 1928, right before the election in the US, where Herbert Hoover won over Democrat Al Smith. A year later, the stock market crashed and the US economy was thrown into the Great Depression. I'm not saying that there's any correlation here, but that's when that ad ran, and it was all of us who studied economics studied that ad. So the levers that the Chinese government has to implement this shared prosperity are not well understood, but there are many, many levers. Property taxation, increasing the minimum wage, capital gains and income tax increases. There are also more drastic ideas, such as granting employee stock. The uncertainty is the problem here. But inequality is real in China. The Gini coefficient, a relative measure of wealth distribution, puts China at about the US level. And nobody would argue that the US is a model of income inequality. If you don't like this Gini coefficient, you can spend a few hours looking at the world inequality database, and you'll come to the conclusion that China is no labor paradise. So longer term, many of the policies that we've discussed in the past can help bring about better and higher paying jobs. Recall the dual circulation and moving up the value chain. Again, we want to stress, these are easy things to say, but hard to execute on a countrywide level, particularly top down. Remember, the left hand in China right now is beating down innovation, while the right hand is saying, encourage domestic champions. Fitting this through the eye of the needle is going to be very difficult.
Shared prosperity is absolutely is a good objective. So it's I think in the reality, China, United States, Latin America, they all face the similar problem. And so that is a social problem existing in each society. How to solve it, I think is extremely difficult. From just see the history, from China's history, shared prosperity is happened many times. And a lot of people, generation by generation, they used to try the different way to do it. And fortunately, it's not get a good result in the history. Mm-hmm. So I think right now is how to solve this problem. Maybe in the world, the many countries they already have that like that use the tax, use the different transfer social wealth, have many different ways to practice or try to remedy such kind of a problem. Unfortunately, this is still exist. And also right now we are in the international world, and that means rich people can transfer monies to the different countries. That really means a lot of the older solutions might not work. I think that's really the challenges for the political or whoever manage the public managers facing the problem.
Right, and because capital will, even though there's capital constraint, capital will fly, right? There's no doubt about it. It can move.
Yes, another very important thing is I think the entire society is like an ecosystem. In international world is also like the ecosystem. You cannot just think I want the biggest pie, I want to do everything benefit myself, and then you will get the maximum benefit, and that doesn't work at all. So, and sometimes you already get a lot of the international benefit, but you have to recognize we are in the ecosystem.
Yeah, so that's why
you have to balance it. Yeah.
That's why we learn in economics that you can create wealth. Wealth is infinite. It's not like if I have wealth, I'm taking from you, I'm creating more wealth, and that's the concept here. This shared prosperity is makes me feel like wealth is finite, and wealth is not finite. It's infinite. It's just how do you get more people to benefit from the increasing wealth that's happening in society? And I think that's the real problem. And you don't have an ownership society right now that is easily executable. So if more employees owned more shares, then you would have this greater wealth effect. So even in the U.S., a lot of people hating on Facebook or hating on Amazon, but if those employees owned shares in Facebook and Amazon, they'd be a lot happier, I can assure you.
That's true. So they have to, I think they have to take the actions. And obviously, there's a lot of the existing interest, the groups, they may or may not want to give up some of the benefits. So this also might hurt the create the wealthy as well as the transfer the wealthy among the different social groups. I think it's very hard work. Definitely nobody can happy about that, and hopefully the entire wealthy could get increased after some of the change. I think most important thing is just still set the kind of the investment performance, just to say if any policies or actions works or not work.
Yeah, we have to make sure that we do watch taxation. I mean, China's never been known as a low tax environment. And in fact, it's probably a pretty high tax environment. And what benefits will accrue to shareholders? That's something that people are going to watch very, very closely, because if you own shares and if you own equities and the value doesn't accrue to the shareholder, but maybe accrues to employees or maybe accrues to management, then that's, clearly you have a moral hazard issue. So people are going to watch how this shared prosperity flows downhill.
Yeah, it's very hard, I believe.
Yeah. Well, that's it. That's going to be it for this week. We want to thank everybody for tuning in. Make sure you hit the subscribe button. We're almost on show Z. It's that means 26 shows in the can. So that's a lot of work from our end. Hope people are benefiting and learning something about the investment thesis that is China. Thanks a lot.
Thank you.